Ladies and gentlemen, esteemed speakers, and dear webinar participants. It's with great pleasure that I welcome you to our latest webinar hosted by the European Enterprise Network. My name is Birgit Weidel. I'm head of department at ESMEA, the executive agency managing for the European Commission a number of funding projects, and one of our flagships is the European Enterprise Network that is organizing these webinar sessions. These Embracing Global Market series offer crucial market intelligence and comprehensive regulatory guidance, supporting European businesses and innovators to expand in dynamic markets across the globe, including Asia, Africa, and the Americas. With our webinars, we want to reach out to a very wide audience, including, in particular, European small and medium-sized enterprises with the ambition to go beyond the EU market, startups ready to scale up their business internationally, in particular, our Seal of Excellence holders and the beneficiaries of the European Innovation Council, but also the dedicated business advisors of the Enterprise Europe Network, European cluster managers, and any other professionals from other European business support organizations. For those who may be joining us for the first time or are unfamiliar with the Enterprise Europe Network, let me say a few words on its activities. The EN, this is the short name for the Enterprise Europe Network, is one of the world's largest service providers for businesses with international aspirations. It plays a crucial role as a facilitator of global trade and innovation. And as I mentioned before, it's funded by the European Commission. Benefiting from a collective expertise of more than 3,000 experienced business advisors, the Enterprise Europe Network establishes a vast global commercial marketplace for trade and R&D cooperation, connecting the EU single market with attractive business opportunities in other major trade blocs and growing markets across the globe. In a nutshell, the Enterprise Europe Network offers premium business and technology partnering services, coupled with in-depth advisory support, helping companies to innovate, to expand in new markets, and to adopt sustainable business models. In today's webinar, we will shine a spotlight on what you need to know about taxes when doing business in the US. We will take a comprehensive look at the US tax system for corporations and delve into key aspects such as corporate tax rates, taxable income thresholds, tax credits, state tax regulations, tax reporting and compliance requirements. We will hear about tax implications associated with various investment vehicles, including corporations and partnerships, but also exploring capitalization and funding strategies tailored to the US market. And we will unravel, or at least we will shed some light on the complexities of common American tax incentives and their impact on foreign companies seeking to establish a foothold in the US market. I would like to extend my sincere gratitude to the European American Chamber of Commerce in the Carolinas, as well as to our esteemed panel speakers who have put in countless hours to make these sessions possible. We appreciate your dedication, and we are immensely grateful for this opportunity to get insights into the intricacies of doing business in the US. Let me also encourage all webinar participants to participate actively in this webinar and to interact with our experts. Raise your hand or post your questions via the WebEx chat or in the YouTube comment session. Importantly, if you need further support with navigating the US market, the Enterprise Europe Network stands ready to help. Do not hesitate to reach out to our local enterprise network contact points. You can find all contact details on our official Enterprise Europe network website. And now I'll hand over to the moderator, Fernanda Sieverling. She is the Executive Director at the European American Chamber of Commerce in the Carolinas. She will expertly guide us through today's session. Fernanda, the floor is yours.
Thank you so much, Birgit, for the kind words, for the welcome. I'm delighted to be here today. You already introduced me. I am the Executive Director of the European American Chamber of Commerce in the Carolinas, and I'll be moderating today's webinar. First, I would like to extend my gratitude to Birgit Weidel, Head of Department at Eismeyer, and to her team, as well as to Alberto Valenzano and his team at DJ Grow. A warm welcome to all the attendees joining us for the webinar today. Before we delve into the program, allow me to share a few words about our organization. Despite joining the EN just last year, we have already become involved in various sector groups. We are members of the aerospace, automotive, and agri-food groups. We have plans to join the health sector group in the near future. If your organization is interested in hosting a delegation of experts from the US to advise your members or a group of companies about how to access the US market, we are happy to bring them to you. We are embarking on our first delegation trip to Europe in June, where we have been invited by the Brussels Chamber of Industry to discuss US market access with their members. We are open to extending the service to other chambers or organizations interested in hosting us. Furthermore, we would be delighted to host your delegation in the Carolinas if you're planning a visit to the US. This will provide you with the opportunity to explore two of the best states for manufacturing projects in the US, South and North Carolina. And lastly, if you wish a more tailored webinar for your organization, you can also contact us. Our email address, hopefully visible at the top of the screen, is en@eacc-carolinas.com. So I noticed there are many questions in the survey, and I'm not sure we may be able to address all the topics. However, please don't hesitate to reach out if you would like a more tailored webinar for your organization. Of course, you can always contact our speakers directly as well. And now let's begin. If you have any questions during the webinar, please type them in the chat, and if time permits, I'll address them. I would like now to introduce you to today's speakers. Paul Kausoulis, International Practice Director at Elliott Davis in North Carolina, has more than 25 years of combined tax, finance, and international experience with large and mid-sized companies in different industries. Paul's area of expertise includes US and foreign tax reporting requirements, transfer pricing documentation and planning related to both inbound and outbound foreign investments, mergers and acquisitions, and related corporate restructuring. Austin Carlson is a partner in the Houston office of the law firm Gray, Reed & McGraw LLP, a full-service law firm with 150 attorneys across 3 offices in Texas. As a business lawyer and CPA, Austin Carlson brings unique skills and perspectives to every area of his practice, which includes corporate and tax counsel on merge and acquisition deals, complex corporate and tax planning for domestic and international transactions, and international penalty abatement issues. Patrick Hannon is a director in CLA's Business Incentives Consulting practice. Patrick has over 20 years of experience in credits and incentives, economic development, site selection, real estate development, and urban planning consulting. To start, I would like to ask Paul to give us an overview of the US tax system. Paul?
Yep, thank you, Fernanda. Me. Can everybody see that?
No, not yet. The presentation, we don't see it yet.
Me. Okay. You see that now?
No. Okay, shall I take over? Maybe?
Yeah, why don't you take over here? I'm seemingly having an issue here with trying to share.
Okay. Tell me when you see it in
We do see it.
slides.
I do see that.
Okay. Do you see it in full mode? Or not yet?
No, not yet.
Okay, wait 1 second. Yes. Okay. It's
There we
okay
go.
now?
Yes,
Okay.
that's in full mode. Yeah, as Fernanda noted, I will spend the next few minutes providing sort of a general overview of U.S. business taxation. You want to go to the next slide, please, Alfred? What we will cover here over the next 10 minutes or so, really taxation related to the different entity types that are available for businesses here in the United States. As you know, in doing business here in the United States, you can elect to form a corporation. You can operate as a branch of the foreign corporation here in the United States, or you can choose to form a partnership or an LLC. And now we'll talk a little bit more about how each of these entities are taxed here in the United States. Next slide, please. Starting with corporations, one thing to note about the corporations are that they're really going to be subject to 2 levels of tax. The corporation is subject to tax at the corporate level, and then the shareholders are subject to tax upon receiving a distribution or a dividend from the company. One thing to note here in the United States that's maybe a little bit different in some of the jurisdictions that you're in is that we've got multiple levels of income tax. And so as a corporation, you're not only going to be subject to income tax at the federal level, which is currently 21%, but you might also be subject to a state income tax, and in some cases, a local or municipal income tax. So that is one of the things that you need to be aware of coming into the United States, is that there's various levels of income taxation, and state and local taxes really are driven based upon where you're conducting business. As I mentioned briefly, dividends coming from a corporation are subject to tax. If you're a U.S. tax resident, that the tax on the distribution is anywhere from 0 to 20%, and that really just kind of depends on the individual's level of income. Corporations generally are subject to tax at a 21% rate. There are some dividend received deductions if there's multiple corporations in a particular group. Distributions between the corporations may be eligible to be reduced. But as foreign shareholders in a U.S. corporation, it's important to note that the U.S. imposes a 30% withholding tax on any distributions made by U.S. corporations to foreign shareholders. Now, depending upon the domicile of the foreign shareholder, that 30% may be reduced by income tax treaty, and depending upon, country and specific, facts related to the relationship, that 30% may be reduced by income tax treaty to as low as 0% in some cases. Next slide, please. Alternatively, no, you're right. I think you've got it. Branch of a foreign corporation. Generally speaking, the branch of a foreign corporation is going to be taxed similar to a corporation. The difference being is that there's really no shield from U.S. tax authorities with respect to the foreign corporation. I should have mentioned, I mean, one of the advantages of doing business as a corporation here in the United States is the foreign shareholders don't have any requirement to register with the U.S. tax authorities. Upon receiving a dividend, the withholding tax, to the extent that there is one, is really kind of the final tax that's imposed on the foreign shareholder, and the foreign shareholder really has no further U.S. income tax reporting requirements. Here, alternatively, operating as a branch of a foreign corporation, it will be the foreign corporation that ultimately has to register with the U.S. tax authorities, file a tax return on an annual basis, and then also, on that return, identify what is the business income associated with the U.S. branch, because that's all that, eventually gets reported on that U.S. tax return. So that's the one downside of operating as a branch of a foreign corporation, is the fact that the foreign corporation will then be connected to the U.S. tax authorities. They have to get a tax identification number, like I said, file income tax returns with the Internal Revenue Service, and also, the various state jurisdictions to the extent that they're subject to tax in states as well. So that is the one sort of downside, if you will, in terms of operating as a branch here in the United States. And lastly, the U.S. tax rules are designed so that, in theory, you're indifferent operating as a branch or as a corporation from a tax perspective, because not only are you taxed as a corporation on your income here in the United States, but to the extent that there is, a deemed distribution from the branch back to the parent company, we do have a branch profits tax. And that branch profits tax is designed to simulate the withholding tax that would otherwise be, attributable to dividends coming from a corporation. So, in theory, you should be indifferent in terms of doing business through a corporation or via branch, because both will be subject to income tax on their business income in the U.S., and they will also have a withholding and or branch profits tax on distributions or deemed distributions coming from the U.S. entity. Okay, next slide, please. And lastly, you can operate as a partnership or an LLC here in the U.S. The partnership and LLC really are considered to be transparent entities here in the United States. So really just one level of tax. That income is taxed at the partner and or member level, depending upon what type of partner you are. If you're a U.S. partner corporation, you'll be taxed at the corporate rate on your share of income. If you're an individual, you will be subject to tax at the individual marginal rates that vary as high as up to 37% federal, and then there may also be state income tax depending upon which state or states that you're deemed to be a resident in. Now, one thing to remember, as a foreign partner or member of the LLC, you will be allocated a share of the profits or the income attributable to the U.S. business activity of that partnership or LLC. So what that means is the foreign partner, whether it's an individual, or foreign corporation, will need to file a U.S. tax return. So it's the partner that will need to register with the authorities. Depending on whether you're an individual or corporation, you've got your respective income tax returns that you will need to file and report your share of U.S. business income, and depending upon type of entity and if you're an individual, what your income is from that particular share in the partnership will determine, what is your individual income tax rate on that share of income. And the other thing to note too, with respect to the partnership itself, it does have a withholding tax requirement. So to the extent that there's any income that's allocable to a foreign partner, whether it's individual or corporate, the partnership does have an obligation to withhold U.S. tax on that foreign partner's share of partnership income. So in the end, what happens is, as I mentioned previously, the foreign partner will need to file a U.S. income tax return, determine its tax liability on that income, and then it will be allowed a credit for any withholding tax that was withheld on their behalf by the partnership. So if the income on the share of income is less than the amount of the withholding, then the partner would be entitled to a refund effectively on any payments that are in excess of their final liability. One thing I did want to mention, with respect to LLCs, they can be a little bit tricky in the international environment because under U.S. tax rules, the LLC will default to a transparent entity. Now, I know and I'm aware that many foreign jurisdictions view the LLC as a corporation, so you could run into situations where, for U.S. tax purposes, you're allocated a share of the partnership income, you pay tax, let's say, in a particular taxable year. But if the corporation, the LLC, doesn't make a distribution, then there's no income to be recognized for local country purposes. So you might get a mismatch, for example, if you're entitled to foreign tax credits, in year one, like I said, you might receive an allocable share of U.S. LLC income, and you'll be subject to U.S. tax on that, but you may not have any income from a local country perspective. And so my advice there would be, before you set up an LLC here in the United States, consult with your local tax providers to make sure that you understand from a local perspective how that LLC will be regarded for local country purposes. There is a little bit of flexibility, though, with LLCs. LLCs, as noted in one of the bullets here, can make an election to be treated as a corporation. So, if that is the case, then, you would be sort of, in sync, if you will, between how it's taxed here in the U.S. and how it may be viewed, from a foreign perspective. So again, the LLC offers a little bit of flexibility in that it can either be considered a transparent entity or it can be also treated as a corporation for U.S. purposes. Next slide, please. And just some quick general U.S. tax concepts. Our taxable, tax liability here is based on taxable income. Keep in mind that going from book to taxable income here in the United States can be fairly complicated. We have potentially many adjustments that need to be made to the financial statement income in order to arrive at taxable income. So that alone will likely be more complicated than it is in other jurisdictions. As I mentioned previously, states also impose income tax. Additional layer of complexity is the fact that state taxable income is determined using state rules. So federal may not necessarily apply to how you calculate taxable income for state purposes. And so, as you might imagine, if you're filing in a number of individual states, you may have, considerable complexity in terms of determining taxable income for all of the jurisdictions. We do have an alternative minimum tax, but that really applies to very large companies. It only applies, at least the way that the law is currently written, to companies that have financial statement income in excess of $1 billion. Or if you're a foreign parented multinational, you have to have, the $1 billion of book income for the group, and then the U.S. company or group of companies needs to have at least 100 million of book income in order for the alternative minimum tax to apply. So it's not widely applicable, shall I say. Keep in mind that, we have annual returns that need to be filed both for federal and state. You can pick different fiscal years here in the United States. You're not bound to, let's say, the calendar year. So entities can choose their fiscal year-end dates. The U.S. tax returns themselves, can be fairly complicated, can get very thick, because depending upon your type of income and expenses and, whether you've got other foreign investments, things like that, transactions with related parties, there are additional forms that may need to be completed as part of the tax return, not necessarily related to the determination of income tax, but more informational reporting so that the U.S. authorities have more clear visibility into the operations of the companies. And then there may be other tax credits and incentives that might be available to reduce the tax liability, which we'll talk about in just a little bit. Next slide, please. And then some of the other things that we'll touch on yet today are selection of entity type. I'll talk a little bit more about debt versus equity. We also have sales use taxes, property taxes, other investment incentives, which again, we'll touch on as part of the remainder of the presentation. And just one caution, when you're starting out, doing business here in the United States, if you're sending people over to the U.S., you just have to be mindful in terms of how much time they spend here in the U.S., not only from a, let's say, maybe perhaps creating a permanent establishment for the foreign corporation, but individuals can become tax residents here in the United States. We do have what's called this physical presence test. So you just have to be mindful, if you're sending an individual over here in sort of a business development or startup phase, just keep in mind that you don't want to create a situation where, they become tax resident here in the United States, because that does dramatically change how they as individuals, might be subject to tax here in the U.S. So let me turn that back over to Fernanda, and we'll start probing into some of these other considerations a little bit more deeply here for the remainder of the presentation.
Well, thank you so much for this overview. I think it's very helpful. And there is already a question coming from someone on the chat, and maybe you can address that very short. And the question is about technology startups like digital marketplace. Can it happen that I'm not even in the US, but I need to pay tax over there?
Yeah, it sort of depends. I mean, and certainly I'll reach out to Patrick for the state income tax consequences. But generally speaking, I think from a federal tax perspective, if you're a technology startup, the U.S. does not have a digital service tax yet, like some other jurisdictions might have, So if everything is situs offshore, there are no servers, there is no like presence actually in the United States. Generally speaking, the entity itself should not be subject to tax. Now, it depends upon, in part, the type of payments that entity is receiving, and it's probably beyond the scope of this particular webinar. But the U.S. does impose, again, withholding taxes on what's considered to be fixed and determinable income. So if you're receiving royalty payments, if you're receiving license fees, depending upon how they're structured, those payment streams might be subject to tax. But again, that would be in the form of withholding tax, and whoever's making the payment would be responsible, for doing the appropriate withholding on that. But the entity itself, I mean, unless it has some sort of connection or presence with the United States, should not likely be subject to tax.
Great. But the best thing to do is first to talk to a lawyer before starting. On another note, you talked about different types of entity structures. Let me understand that a little bit better. And for that, I have a question for Austin. Could you tell us which kinds of entities are most common when investing in the US?
Absolutely, and I'll make one more quick comment on Paul's question. It's a really good question about digital marketplace, technology startups, and it's an evolving area of law across many countries. But as Paul said, the facts are very important, and we definitely have a number of clients that we're able to have structured correctly, stay out of U.S. taxation. So it's a factually intensive, and to the extent you can create your facts, you can get a good result. But turning to your question, Fernanda, thanks so much. There's always a number of considerations for how you're going to form a business in the U.S. And so we'll tell you what we see as the most common. But of course, everybody's facts and circumstances are going to be different. Also, importantly, what country you're coming from makes a difference, because the United States has tax treaties with over 100 countries and with most countries in Europe, but not every country. And whether or not you are from a tax treaty country can make a difference. But the most common structure we see for creating a US business is through what we call a blocker structure. That blocker is typically a corporation for state law purposes. We don't have federal entities in the United States. You form an entity in one of our 50 states. And then those entities have an associated taxation type. Corporations are the default is that they will be taxed as a C corporation. As Paul mentioned, though, it's also possible to form as a limited liability company, and limited liability companies may choose how they are taxed, and they can choose to be taxed as a corporation. So we often will see either a foreign investment through a corporation that just the default is corporation, or we may see a investment through a limited liability company that makes an election to be taxed as a corporation. The advantage of a limited liability company can be that even though the taxation is the same, but that there are less corporate formalities, they're easier to form, easier to manage. But you do need to make sure that the country you're coming from does not have any sort of unintended issue that comes from it being an LLC. If you're electing to be a corporation, then usually the issues Paul talked about of there being kind of a mismatch or hybrid don't exist. The blocker is called a blocker because it blocks the U.S. income from being attributed to the owner. That owner could be an individual, it could be another foreign business entity. The advantage of that is, as opposed to operating directly as an individual or through a foreign branch, is that you isolate liabilities for if there's a lawsuit, et cetera. You also avoid having the owner having to register in the United States and get a taxpayer number. And in general, you're able to kind of better manage the income because it is going to be attributed solely to that entity, as opposed to when a foreign branch, there's more arguments that some of the foreign branch's income could be subject to U.S. tax. So it's a very clean wrapper of this is kind of what you're doing in the United States. Which state you form in, and we can talk about that more later. You often see Delaware because Delaware is a jurisdiction that is very easy to form in. And it is also the law is considered very business friendly as far as entering into contracts. Also, every lawyer in the United and every business person in the United States is generally familiar with Delaware, as opposed to I'm in Texas and I may not know as many nuances of South Dakota law or a Carolina law, but I will of course know Delaware because we all are it's kind of our second language, if you will.
Mhm.
So finally, one other consideration is, will that U.S. entity be owned by an individual or through another structure? And in addition to the income tax, you also have to be aware that there are U.S. estate tax concerns. Our U.S. estate tax is on non-residents is 40% over a very, very low threshold of $60,000 US. There are a few countries that we have estate tax treaties that can help with that exemption amount. But if you're not from one of those, you need to be very aware of that. And if the individual on their own owns into the US business entity and they pass away, they could have a very significant US estate tax bill. If instead you have a structure such as a foreign company that owns into the US estate tax is not assessed onto businesses. So that is one of many structures that can get you out of the estate tax.
Okay, great. So important, if I got it right, is really so to balance the liability, and if you wish to have the tax directly on your person or through the company and to pay the tax on the dividends. And you mentioned something different about the different states that you have in the US, and that brings me to another question, and that would be for Patrick. Patrick, we have here 50 states and numerous cities. How do the various tax regulations impact business operating in the United States? For example, in Europe, you are familiar with VAT or VAT, but when you arrive in the US, you hear about sales and about use tax. How does that work? And what other taxes exist on the state and municipal levels?
Yes, as opposed to the tax structure in Europe, the tax laws and regulations in the US can be really complex and vary significantly from state to state and from city to city. So this can make it pretty challenging for businesses, first beginning to operate in the US to comply, with all of these different requirements. Sales and use taxes in the US, which apply to a varying number of things, all the way to your utilities, to everything that you purchase. There can be exemptions. There are different rules that apply in terms of collecting and providing those back to the government, as well as your payments of those taxes. And they vary greatly by state as well as by city, and each has a different level of sales and use tax applied to it. Very difficult to keep track of all the different requirements, and can result sometimes in additional administrative costs or potentials for penalties for noncompliance. We have property taxes in the U.S. that tax both your real and personal property, and those property tax rates and assessment methodologies vary quite a bit by different localities at the state, county, and city level. So they can impact your bottom line on how profitable you are, just because they can be a very significant impact, as Austin mentioned, of tax impacts. There are also abatements and different incentives that can help offset those costs and provide significant value to companies as they're investing in the U.S. So those are considerations you want to make up front before making a decision to where to locate and what to invest in. There are also state income taxes that are vary greatly between state to state in their form as well as the amount. Some states may not have an income tax, but they make up the difference for not having an income tax by having higher property taxes, or having an increased sales tax that applies to different things. The state of Florida, you can tax your leases for property, capital leases, but they don't have an income tax. So each of the states have a way that they're going to make up their tax revenues, but it can impact the different industry that you're in and the structures that you create for your corporation as well. So it's important to try and navigate and figure out what the best model is for you up front. For example, manufacturing, businesses can be subject to a lot of property taxes, their equipment, sometimes their inventory can be taxed, and those can be significant impacts to a manufacturer that might not be as significant to a high-tech company or a technology company that's opening just an office, in the U.S. or a sales facility in the U.S. Additionally, some states have specific tax incentives just to manufacturing operations. And on the flip side, they also have specific tax incentives to encourage manufacturing growth. So again, it's important to take those considerations into play up front. Specifically to a technology company, technology businesses, can operate across multiple states and multiple taxing jurisdictions, and sort of have to track what how those jurisdictions might impact them. There might be earnings taxes in certain municipalities that they're working in that they would need to pay for operating there. And it can really, all of these can create a very big impact on the overall success of a business.
Yeah,
Can I just add one comment there? One, I guess, trap, Patrick, right, is the fact that while, you might be, let's say foreign company might be exempt under a treaty for U.S. federal purposes, our states are not bound by the U.S. federal treaty. So I've come across situations, for example, where the treaty allows for the foreign company to maintain a stock of inventory here in the United States, let's say in a third-party warehouse. Well, under the treaty, typically maintaining a stock of inventory is not going to create a federal taxable presence, but I believe that will create, in some states, a state income tax presence. So just be mindful of that even though you think you're out of the woods, because the treaty applies, it doesn't necessarily apply at the state level.
right.
As an add-on to that, just in the same way that you have to do an analysis of whether, if you're operating outside the U.S., when you trigger U.S. taxation, you have that same analysis, but with 50 states. Even though, they're under the federal government, in some ways, it's like they're their own country and they have their own triggers for when taxation occurs there. So that does create, a significant amount of additional complexity if you're going to be operating across state lines in the United States.
So Austin, once that you're there and mentioned this kind of topic, let's stay there. And I have another question for you. What are the most common mistakes made by new foreign-owned business in the US?
Well, thanks for that question. I'm happy to discuss. So I was thinking through, and we see lots of different things occur. One, I would say the first one I think that comes to mind is triggering unnecessary U.S. taxation. So to get to the question we had earlier, to the digital marketplace, that's a good example that it may be possible with good structuring to not be subject to U.S. taxation. The other one that Paul mentions that we see very regularly is for individuals. So let's say you form a U.S. business and you may be coming to the United States to monitor that business. Our rules for when you trigger tax residency are very different than the rules in Europe. And we don't have, it's not just 183 days in the current year. There is a look back period over 3 years. So it's possible to trigger US resident taxation a lot sooner than in other countries. And if you are considered a US tax resident, you have to pay tax on your worldwide income and you have to report your worldwide assets. And we have very significant penalties for failing to report foreign assets. So when considering going to the U.S. or having interactions with the US, you need to be very careful that and intentional that if you are to trigger taxation, you know what you're doing, and you don't want to accidentally trigger it. A few other items. It's essential to coordinate US and foreign taxation. Whenever we help assist with a structure, we always need to talk to a tax advisor in the country where our investor is coming from to make sure that I can come up with the best structure from a US standpoint, but I need to make sure that that does not trigger unnecessary consequences or adverse consequences with the country of the investment. Two more. One, knowing relevant tax deadlines and required tax filings. It's not uncommon for, I will set an investment up, and if for whatever reason, it's a first time filing, the investor just may not be aware of the various deadlines. And there can be significant material adverse tax consequences if you fail to meet one of those deadlines. And then finally, as I alluded to, our state's our federal taxation is in some ways much simpler than the states. And I do see issues with failing to properly address state issues. One very common issue we see is with sales tax. So we don't have that in the United States. We have sales tax, which is similar, but kind of a different beast. And every state has different rules about what is subject to sales tax and what is not. But sales tax can be really, in Texas, our sales tax is 8.25% at the highest. And that's supposed to be collectible on taxable sales and services. And so if you fail to do so, those numbers can add up very quickly on having issues. So in short, making sure you've got the right advice and the right team will help you with avoiding these mistakes.
Yeah. Thank you so much. I think it's really important for us to understand this difference in taxes so that we do not get any nasty surprise. I was really surprised when I moved to the US. In Germany, I pay as much property tax in 1 year as I do it in 1 month here. That was not a good surprise for me. Now let's go back to Paul. Paul, what is the best way to capitalize a US company?
Well, I guess, the short answer is it kind of depends, right? You can capitalize the company, using equity. Or you can also use debt. Now, if you're considering debt, we don't really have, like a safe harbor any longer. I mean, I know some jurisdictions will have like a 3-to-1 debt equity ratio. What we have here in the United States is an interest expense limitation, and it applies to all debt. So it doesn't matter whether it's bank debt or whether it's, let's say, intercompany loan from the shareholder. The interest expense is going to get capped under these provisions. And essentially, these provisions are 30, it's 30% of your adjusted taxable income. So you calculate your US taxable income first. There's a few add backs that you make. You come up with your adjusted taxable income. You take 30% of that amount, and then you compare that 30% number with the amount of interest expense that you've recorded and is able to be otherwise deducted. We've got other interest expense, considerations that need to be taken into account as well. But essentially, you're capped at 30% of this adjusted taxable income. So that would be the one thing to sort of keep in mind. I mean, if you're going to use debt, are you going to be able to fully deduct the interest expense related to that debt? Now, if you're thinking about capitalizing with intercompany debt, then I think you have, some other considerations you need to take into account. You do want to make sure that you properly document it. We don't really have, sort of a bright line that defines what constitutes debt. I think it's really been over time, there's, various indicia that courts have looked at to determine whether it's debt or equity. I can tell you from a U.S. tax authority perspective, if there's a gray area in terms of whether that debt is really debt or does it really look and feel more like equity, they will argue equity because, effectively then any payment coming off of that loan will not be considered to be an interest payment. Rather, it's likely going to be considered to be let's say, a deemed dividend. So you have to be careful and you have to make sure that you properly document any, let's say, shareholder loans into the U.S. company in order to be able to preserve, let's say, your position that it really represents, debt and not equity. That's really important with respect to the shareholder loans. And then lastly, if it's with a related party, you have to keep in mind that any interest expense that is agreed upon between the parties is determined on an arm's length basis. So that, kind of gets into the transfer pricing world, if you will, where, the two related parties need to operate as if they're independent. So, you would look perhaps to, outside, let's say third-party loans. What does a third-party loan, generate in the way of, let's say an interest rate? We do have some safe harbor rules here in the United States. If the loan is denominated in US dollars, we're allowed to use what's considered to be a published rate here every month to determine what is like the safe harbor interest rate that the US tax authorities will allow, with respect to an obligation. But again, that would need to be confirmed on, let's say, the shareholder side to make sure that, whatever interest rate we pull from our published rates is adequate from a local country perspective. But, you can choose relatively easily between the two. And so again, I think kind of getting back to Austin's point, making sure you've got the appropriate advice on the front end, we can help kind of model out the implications. Are you going to run into some sort of an interest expense limitation? So on and so forth. So again, as you're forming the entity and looking to fund it, just make sure that you've got the appropriate advisors at the table at the time.
And as a quick add-on, this is another area where the country you're from will make a difference. You have to look at the tax treaty, one, if there is a tax treaty, and then two, look at the terms of the tax treaty. The United States has different withholding rates for dividends and for interest across the different tax treaties. So that's yet another factor that could make you lean towards one versus the other if the withholding rate is less and if that makes a difference to your overall structure.
Just one last comment on that. The difference also between the debt and the equity is like if you're expecting to be profitable and looking to bring the cash back in fairly short order, by putting debt in place, the interest may be subject or may not be subject to a withholding tax. But generally speaking, you can repatriate or bring back the principal of the loan on a tax-free basis versus if you put the funding through equity, any kind of, cash out on the equity is going to be treated as a dividend more than likely for U.S. tax purposes. So again, it's one of the factors to consider, if you're looking to bring cash back out of the United States, some debt would likely be beneficial because that could be brought back on a tax-free basis.
Yeah, that's great. Thank you so much. So we all see it's very complicated, the tax system here. Nobody should come to this country without a proper advisor. And we are running out of time, but I would love to ask a last question. And this goes to Patrick. I think that's a very important one for foreign investors. And we are now talking about incentives. Patrick, what are some common tax credits and incentives offered at the state and local government levels, and how do they encourage economic growth and job creation? I'm thinking of the Inflation Reduction Act, for example, and how can I qualify? I know that's a topic for hours, but please give us a short overview.
Yes, yeah, we could definitely spend an hour just on this topic alone. So the incentives vary just as much as the taxes do in the U.S. across the states and localities. But we try to encourage activity mainly in different buckets. So we look at investment tax credits, that are designed to encourage investment in real estate, in purchases of machinery and equipment, your furniture, your fixtures, your computers, things like that go into setting up your business. You can receive either some advantageous financing to purchase those tax credits that can discount your income taxes that are due at the end of the year, or even some abatements on the property taxes associated with those purchases. Even some sales tax offset or exemptions. We encourage job creation by providing income tax credits or allowing for companies to retain the withholding taxes that are due on the creation of new jobs or the retainment of new jobs or retention of jobs. Additionally, if you have to train those employees, there's tax credits available or funding grants that are available to help train employees or provide the training in kind through community colleges and various places. There's research and development tax credits available at the state and federal level, as well as property tax exemptions on new construction of real property or purchase of machinery and equipment, sales tax exemptions across the board for new activities. You can even exempt the sales taxes of the construction materials going into a new construction of a new office or new manufacturing facility in many places. Overall, those are great ways to lower the impact of taxes on your business. And then we have the Inflation Reduction Act, commonly known as the IRA, which is federal legislation that was passed to bolster the energy efficiency and renewable tax credits in the U.S. One of the most significant changes it created is it extended a lot of the benefits that were already in place for programs for solar and renewable energy production, but it also created new buckets of available tax credits and incentives for the production of the equipment to create renewable energy and the investment in renewable energy in general. It made a lot of those tax credits transferable and for sale, which is great for companies that may be cash short up front. They can become a upfront financing option. And there are just a ton of nuances to IRA that we can't get into here, but there's domestic production requirements, things that can greatly impact the viability of the opportunity for particular businesses.
Great. So thank you so much. I'm pretty sure there's still lots of questions outside, but our goal today was simply give a high-level overview of the tax system in the US. And so again, if you want a more in-depth webinar with our experts, or even that we come to your organization in Europe, you can contact us at en@eacc-carolinas.com. I would like to say thank you again to all our speakers today. And now I will pass the word to Alberto Valenzano.
Thank you, Fernanda. From my side, I will conclude very briefly. I don't want to take too much time from the participants. First of all, I want to thank you, Fernanda, also Austin, Paul, and Patrick for giving all your insights on the taxation system in the US. As I think participants have understood that it is indeed a complex system. At the end, the US is a federal state, so it can be much more complicated than people think, and it's probably not less complicated than what the situation might be in Europe at the end. But I guess taxation systems are never easy anywhere in the world, so I don't think it came as a surprise to any of the participants. I think the most valuable suggestion that you made, Fernanda, is before you decide to do business with the US, talk with a good US tax advisor or a lawyer or someone who knows the system well and can guide you into the first step and understanding the basic system before you actually start your business endeavor in the US. And I think that our colleagues who have spoken today, and especially the European American Chamber of Commerce in Carolinas, can support you in this if you're a European company who want to start. So don't hesitate to contact them if you are interested in starting your business journey. Then, as in next steps, I want to remind everybody that this webinar has been recorded and it will be available. So whenever you want to watch it again, please do. It will be on YouTube and it will be also on our EN Enterprise Europe Network website. There was a lot of information shared today, so you might want to rewatch it again to really grasp all the different details that have been shared with you. And I also want to say that this is not the last webinar we will organize on the US. We have a series. This is the third, and there will be more coming. The next one is on specifically targeting the US sustainable energy market. It will be organized on the 23rd of May. So if you're interested in this specific sector, please join us. It will be, as always, streamed live on YouTube and on the WebEx. So you can join us. It will be from 4 to 5 p.m. Central European time on that day. And feel free also to share this webinar and the upcoming and past webinars with any companies or stakeholder you think might be interested in it. Everything is publicly available, so don't hesitate to promote and share. And with this, I think we can conclude. Wish good luck to all the participants if there are businesses who want to start your journey. And thank you again for everybody for participating and also for the speakers for sharing their knowledge.
Thanks for having us.
Thanks, everyone.
So long now.
Thank you all.
Thank you.
Bye-bye.
Thanks, everyone.